Good morning and welcome to Aspida Group's seminar on greenwashing. I'm Richard Bray from Aspida Group, and we have with us today my colleague and Aspida Group consultant, Stephen Cuddihee. We're joined by the excellent team of Ajit, Natraj, Carl, Shirag and Sam from Quantum Investment Management. I'll shortly be handing over to Steve to give us an introduction on the subject of this seminar before handing on to the Quantum team, who will be sharing with us their experiences of responsible investing in India and demonstrating the rewards of sustainable investing alongside the dangers and minefields they meet along the way. Here you'll be introduced to not just greenwashing, but also hogwashing and eyewashing. First, the usual Zoom webinar notes. We should have time for a Q&A session at the end of the seminar, so please feel free to write down your questions in the Q&A as we go along. I'll keep an eye on them and ask the questions at an appropriate time or at the end. So with no further ado from me, over to you, Steve.
Thank you, Richard, and morning, everybody. I'll keep the introduction fairly quick because obviously I think you want to hear what Quantum have to say. So just to give a kind of an overview of greenwashing and how what it basically entails and how we believe it impacts the fund management industry. So in recent years, the number of funds claiming to be ESG or impact or green or sustainable, which for the purposes of this discussion we'll all term as ESG, has been under the ESG banner, have been increasing in quantity. And this has led to increasing investor demand for ESG products. However, at the present time, there's no universal definition of what any of these terms and such products, investment philosophies and holdings can differ, and they can differ widely. As a result, there have been a number of concerns about greenwashing. And greenwashing is basically the misrepresentation of investment products that make them appear more environmentally sound than they are, and make investors believe that investment manager and its products are doing more to protect the environment than they really are. There's a kind of a dark side to ESG investing, and the cynics among us may think that some investment managers may look at the ESG market and think how they may use it to increase their assets under management. As a consequence, I think investors now are increasingly becoming more concerned about greenwashing and demanding that their ethical considerations are addressed by the investment management industry. To achieve this will require investors and their advisors to be able to interrogate investment managers on their ESG approach in relation to its product offerings and identify any potential greenwashing on behalf of the investment manager. On this topic then, what should investors be looking into? And we've kind of identified 5 key attributes that should assist investors in determining if an investment manager ESG credentials are genuine. And this is what Quantum will consider and review when we introduce them. So one is that investment managers need to be more transparent in relation to their ESG credentials. Genuine ESG managers should be transparent about how they invest and be prepared to be challenged. They should present clear and simple information explaining how the team manages ESG investments and funds. In addition, it's also important that a fund manager or fund practice do what they preach. It is important that the fund itself has a good environmental track record and that the fund managers themselves are able to demonstrate their ESG principles. Secondly, advisors should be wary of meaningless taglines such as sustainability is in our DNA, which have more to do with marketing than any true cultural adherences to ESG. Thirdly, it's also important that of the experience of the actual fund management team who are investing in ESG, both from their ESG credentials and how they're managing investee companies that are purporting to be invested in ESG principles. Fourthly, I think fund managers also have to be constantly involving their expertise. Sustainable investing is a specialist area, and issues such as climate change rapidly evolve. Investors need to be confident that chosen fund managers not only have deep knowledge, but are equally committed to ongoing professional development in this respect. And lastly, I think fund managers should also live with their beliefs through activism. They need to be able to disclose their track record of holding companies to account and encouraging improvements. Investors need to be given detailed information on a fund manager's engagement priorities, whether diversity, tax transparency, or plastic pollution, rather than just making sweeping statements. Equally as important is their voting history at annual general meetings. So I think that's just setting the scene, giving some examples of how, what people should be looking for on greenwashing. And now I'd like to pass over to the Quantum team. Quantum team have been involved in ESG investment for at least the last 10 years and have developed, ESG principles and policies within their operation. And it'd be fascinating to hear from them, particularly on what they're looking for when they invest in investee companies in India and across the globe. So can I pass over to the Quantum team?
Thank you, Stephen. Richard, thank you for inviting us to present at this conference on what we've termed eyewash, hogwash, and greenwash, the EHG as opposed to ESG. So, I guess our first slide, we've been around for a long time. If I can go to the slide of the disclaimers, as you can see, they're in very small print, but the basic thesis, again, in full disclosure, is that obviously past performance, no guarantee for the future. And, clearly from the quantum asset management company slide, because we're giving a lot of data on the QAMC, which is a 100% subsidiary, which manages the ESG products in India. So we've been around, as the slide indicates, for over 30 years. We have a fairly small but distinguished client base of global pension funds, sovereign wealth fund. And all this in an environment where crony capitalism and I guess a lot of greenwashing will be quite prevalent within India. So India and the corruption perception index is 86 out of 180 nations, recorded a year and a half ago. As a firm, we manage over 3 billion in India. And of course, about 2.8 billion of that is on the equity side. Just to give a sense of history, our value investing, which we call value investing with a value system to it, the integrity screen, has since July 2000, so about 21 years, has outperformed the local indices, net of fees, and also the S&P. So we've been around a fair time and used integrity screen. Let me just talk a bit about how we came across and evolved into the India responsible returns and how we use ESG as a criteria and how we practice ESG. So in 1996, we had the integrity screen. This really was to sift out bad actors on the corporate stage in India, with the crucial message that, if you shake someone's hand and you want to get your hands back, you want to make sure that you got 5 fingers after that handshake. So we made a lot of mistakes, learned a lot, and tried to figure out how do you keep client capital safe while investing in India. In 2014, as we read more and more about this formalized ESG structure, we took the process of integrity screen, created our own proprietary framework, which is the ESG framework. And, we've had a lot of discussions and fights or arguments with groups in India in the past. We're not very popular because we tend to ask embarrassing questions or awkward questions to people who believe that no questions should be asked of them because they're large companies or well-known people, etc. At the end of the day, the way we perceive it is that we have to have sensible stewardship of long-term capital in India. We have to reduce what many people are concerned about. One is the headline risk. The other is the actual risk of supporting bad actions and bad actors. So we do that in 2 ways. We've got the value product, where the primary focus is valuations, and there's a certain minimum ESG score based on our proprietary research that you have to qualify to remain in the portfolio. And more recently, we've taken the India responsible return product, which is primarily based and only based on ESG scores, with only one proviso, that the financial stability of the firm is ensured for it to actually survive and implement its long-term plan. So we do not estimate EPS growth rate. We don't look at PE ratios. The basic thesis is, if you're a good actor, if you're a good person, it shows up in your ESG scores, and as such, you will do very well. So that's where we end up in India Responsible Return product. And what we've done also to ensure that while we ask external companies, external people, portfolio companies of questions, we believe we need to shine the light inward. So we were the first company in India and the 51st in the world to tie up with for example, with Workforce Disclosure Initiative, which is part of the Share Action. And this is a process where we're learning internally ourselves how good or bad we are, and ensuring that our scores are out there in the public domain for others to see, and then taking these same principles and applying it to the external world, to the portfolio company. So, for example, we know our own group greenhouse gas emissions. We know what it was in the financial year 2020. It will be a lot less now, given that we're all traveling on Zoom and not on airplanes. And the other thing is that we're very concerned about women representation. So we live in India in a society where a lot of women are prevented from freely working. So you've got a fairly small number of people, who will apply for a job. And then you've got to see them kind of climb up the corporate ladder and give them enough opportunities and support to do so within the structures that we have of the society in India. So, with that, I'd like to turn over to my colleague Natraj, who can talk about the India ESG Fund and then give examples of what we are seeing on the greenwashing side. Thank you. Over to you, Natraj.
Thanks, Ajit. Thanks, Stephen, and thanks, Richard, for the opportunity. Good morning, good afternoon, everyone. I will cover my 10 or 12 slides in about 5 minutes. While the slides I'm going to cover pertain to our responsible investment strategy, I've tried to include aspects of greenwashing, hogwashing, and eyewashing within those and how we navigate that challenge. Carl, my colleague, will run through actual examples of the greenwashing after me in detail. Now, as mentioned, we started this strategy in 2019, and through this global market volatility on the back of COVID, our performance and ESG process is delivering the desired outcome from a performance standpoint. This slide 15 is again a tabular run through of yearly performance and the progress, and it's been heartening to say the least at this stage, in the early stages of this implementation of ESG portfolio. In the slide 16, just wanted to quickly touch upon the fact that the strategy is scalable to $3 billion without any impact on portfolio characteristics at all, including the ESG characteristics, which I will talk about later of the portfolio. And compared to the MSCI India ETF fees of about 0.65%, we are lower, and you get a cleaner and a greener portfolio, if you will. But the biggest challenge that we face as investment managers running a responsible investment strategy is the availability of information, especially on climate, on gender, and sustainability in general. We spend considerable amount of time understanding the disclosure on emissions by companies, whether they are consistent or are they greenwashing actually. The slide shows the weighted average carbon intensity of the portfolio, apart from not owning companies with questionable corporate governance that Ajit spoke about earlier. As of now, the only exclusions we have are not owning tobacco, alcohol, liquor, gambling companies. But we are not shy to own companies who have relatively higher emission compared to sectors like consumer staples or technology, which tend to be lower carbon, which tend to have lower carbon footprint. But we believe in engaging with these companies actively on ESG performance actively, so that they improve, the quality of disclosure improves, as opposed to excluding them totally and just greenwashing the portfolio. Like I mentioned, 94% of the portfolio emission is contributed by 3 companies that we own, especially in the cement sector. But in our assessment, these 3 cement names have better emission intensity per ton compared to their European counterparts like Lafarge and Holcim. They also meet the EU taxonomy norms, and therefore we have no hesitation in owning these companies, because at the end of the day, they are intent to improve their carbon and footprints, and their disclosures are globally comparable. Moving on, 94% of our portfolio companies again have committed to a carbon reduction. Companies that account for 35% of the portfolio have aligned either to a 1.5 degree or a 2 degree scenario based on the Paris Climate Accord. Just to touch on that, based on these commitments that you see in the table, what we have done is we have measured what is the likelihood of carbon emission over a period of time. And we anticipate a reduction in our intensity of the portfolio by 2030 to the tune of about 45%, assuming there are no changes in the portfolio holdings, assuming the companies don't improve from where they are in terms of their understanding of emissions and carbon and pricing and so on, which obviously will get better because India is pushing really for that, and regulators are also pushing for that. Moving on from carbon to other aspects of ESG, like corporate governance, where we place significant importance. Like I said, from 1996, Ajit mentioned from 1996, our assessment of responsible board focuses on the spirit of the law, not necessarily the letter of the law. In India, regulation states that you should have a 50% independent board, but we know for sure that some of them are eye-washing and have a rubber stamp board. Our knowledge of corporate governance and management in India since 1990 helps us navigate this minefield. So we look beyond the optics, what the regulation states, what the companies disclose, and stuff like that. From corporate governance, moving on to gender, that is a very challenging subject in India, especially in a country like India with significant cultural and social undertones. But the country is evolving, and so are portfolio companies. When we visit a manufacturing plant or travel across India to meet these companies, we spend time understanding their gender aspirations. But so far, services sector has been ahead of the curve, but we see progress gradual, but there is progress. But having looked at this micro aspect of portfolio management and responsible investing, when we talk about greenwashing, we cannot ignore the green challenge that a country like India faces and its impact on global climate change over the next 15, 20 years. As you see in the chart, India's emission currently are well below USA and China levels, and therefore we as a country have not contributed to climate change as yet. But over the next 10, 20 years or 15, 20 years, if the current per capita emission, which is at 2.7 tons per person in India compared to a 4 of a global average or a US average of about 14, if we were to move on that path, and if that is not controlled, no matter what savings in emissions that Italy or Switzerland or UK may achieve, it will blow a big hole in the Paris climate targets. And therefore, a country like India should be, emerging country like India, Indonesia, Africa, should be at the center of the climate debate in our view. So given the climate challenge a country like India is faced with, is our government geared up? Well, if you consider the statements from leadership like Prime Minister Narendra Modi, who announced a premature victory on coronavirus, it's not encouraging. We also aim to be the pharmacy of the world when we wanted to supply the COVID medicines, the statement made by the external minister. But the key message that we want to leave you is that from a country which promised 1 billion vaccine, perhaps you can stop the virus from entering into a developed world by stopping flights. But how do you stop the emission that is coming out of countries like India into the Western world in your own backyard? So I think that's the big challenge, and therefore we believe investors should allocate significant amount of money in what we call the Save the World bucket to countries like India. With this, let me hand it over to Carl to take you through some of the examples of greenwashing in India. Carl?
Yeah, thanks, Nataraj, and a very good morning to all of you who have joined us. So in our experience of researching the sustainability practices of many companies, we've come across some instances of companies either being economical with the truth as far as their sustainability credentials are concerned, or in some cases, even indulging in extreme exaggeration of their overall sustainability performance. So from our perspective, navigating the ESG world also involves paying a lot of attention to ESG practices, which is an acronym for eyewash, hogwash, and greenwash. So what we have done in the subsequent slides is prepared some snippets of information on how companies project their performance, what is it that they want to convey versus what we feel requires actual or greater scrutiny. So the first example is of a renewable power company. Now, more often than not, these are extremely popular, particularly in ESG funds, because they have certain inherent green credentials. But what is often missed is that many of these projects involve acquisitions of large tracts of land. And quite often, we have come across instances of land being forcibly acquired. And as a result, this has led to a lot of community protests. Then when it comes to consumer manufacturing, companies which manufacture consumer appliances, typically devices like fans, air conditioners, and washing machines, a lot of attention is given to the emission intensity of the manufacturing process. Now, while manufacturing related emissions are an important metric to track, in our research, we feel that a lot of emphasis also needs to be given on the use phase emission intensity. So you could have a case of two air conditioners running for similar hours during the year. You have the same cooling intensity, but one may end up consuming lesser energy or lesser electricity than the other, resulting in lower emissions as well as lower electricity bills. So the emphasis should be more on use phase emissions rather than simply focusing on emissions in the manufacturing stage. Then fast fashion is an industry which anyway hasn't got a very good reputation, predominantly for its huge environmental impact. It's extremely energy intensive, requires the significant use of chemicals, water. It's also very difficult to recycle. So it is understandable that there is an eagerness by major players to portray the eco-friendliness of their clothing line. But according to us, what requires greater scrutiny is how sound are the labor practices in the manufacturing operations as well as the supply chain. Are people working under sweatshop type conditions, or are there any policies or initiatives in place to handle the huge amount of fashion waste which gets generated, no matter how eco-friendly the product might be? When it comes to banking, the focus usually tends to be on things like financial inclusion, governance related aspects like risk management and compliance record. What we find in India is there's very little information on how banks tend to integrate the environmental and social risks in their credit analysis and underwriting. So an important metric which we as investors need to ask the banks for is typically the carbon footprint of their lending portfolio rather than of their own operations. Banking in India has also recently witnessed a tremendous rise in digital transactions over the last couple of years. People are making the personal sensitive information available to banks and fintech players, and there is always a risk of it being misused or particularly falling in the wrong hands. So banks need to be proactive about this, particularly in a country like India, where you still do not have very stringent data protection regulations. So moving on to governance, a lot of emphasis rightly is on the majority of the board being independent. But sometimes what we observe is that the true spirit of independence is not necessarily maintained. So we've had instances of companies packing the board with close friends and distant relatives of the founder. So while they may meet the regulatory requirements, in our opinion, the board independence is still highly suspect. Another issue that we look very closely at is the composition of committees. Now, according to best practices, usually we don't like executives who are part of the audit or the nomination and remuneration committees. There are legislations in place also which mandate a certain amount of independent directors. But what we witness in certain cases is that in order to bypass these regulations, the executives of companies designate themselves not necessarily as members of the committee, but as permanent invitees to committee meetings. So you could argue that this is an indirect way of simply controlling the agenda of the nomination and remuneration committee or the audit committee. So we've had instances where a non-executive founder with a very large shareholding was a member of the remuneration committee, and he was receiving compensation substantially higher than the CEO of the company. So it makes you ask questions whether who is really in charge. Then in India, we also have a legislation that mandates that companies spend 2% of their profits on corporate social responsibility projects. Now, these are typically community welfare initiatives like rural developments. You might have certain projects promoting healthcare, sanitation, financial literacy programs, and so on. So a lot of companies do tend to take this mandate seriously. However, we have come across a few unscrupulous managements who tend to reroute the CSR budget to businesses which are owned by them. So we've had cases where a particular company rerouted its CSR budget to an educational institute, which it was owned by the management itself. And that institute was actually catering to a lot of children who come from well-to-do and richer sections of society. So you could argue that the CSR spending wasn't really benefiting the truly marginalized sections of society. Then a lot of companies by law are mandated to report on their sexual harassment cases also. Now, the issue that we find is in a few companies, we've noticed year after year, there are zero reported cases. Now, what we kind of internally debate is this really a sign of a company really doing very well? Or are there problems with the company's culture and the environment where it could be argued that women are not yet able to freely air their grievances? So looking at some of these above examples, I mean, the key message that we want to convey is that we need to dig a bit deeper and stop the excessive reliance on self-disclosure and self-certification. So, I mean, we might be in the minority out here, but we are not at the moment a signatory to the UN PRI. So we believe that unless the PRI has a much stringent mechanism of auditing a lot of these asset managers on the sustainability credentials, a self-declaration for us seems to be a meaningless badge. So the second is we also need to question these net zero targets of various companies. A lot of these net zero targets may be predicated on technology, which is not yet proven and may not yet reach a commercial scale. So you could have cases where companies set these net zero targets, their absolute emissions, as well as the emissions intensity increase over a period of time. And lastly, of course, there is also the issue of a lot of ESG indices, which may not necessarily have companies with the best sustainability credentials. So when my colleague Ajit spoke about the fact that we have an integrity filter in quantum, I mean, when you look at some of holdings, a lot of these India dedicated ESG indices, which are created by the third-party rating agencies, it does have a few companies which actually end up failing our integrity filter. So that is something that we need to closely look at. So moving ahead, exactly does quantum conduct its research? So when we started, we evaluated two approaches. We either refer to third-party ESG rating agencies or develop our in-house expertise. So we kind of decided to go our own way because most of the rating agency reports on companies that failed our integrity filter didn't inspire much confidence in us. Secondly, there was a wide dispersion of ratings, which made it difficult to decide. So typically our research process involves scoring companies on two main factors. One is the disclosures, which we refer to as the quantitative score. So we refer to companies' information in the global, according to the GRI reports, the SASB reports, the pollution control board. So we consult a lot of sources. Based on that, we adopt. So the quantitative or the disclosure score is a binary score where a company gets a +1 if they have disclosed a particular aspect and they get a 0 if they have not disclosed. This score is scaled to a rating between 0 to 100. Then we also have qualitative conduct, which comprises the bulk of our scoring. So over here, we look for various red flags. It could be things like a very poor health and safety record or the emission intensity of a company at a much higher level compared to peers. So accordingly, we negatively penalize companies on their qualitative performance. And the final score is an overall combination of how the company does on the quantitative and qualitative aspect. So we give a 30% weight to the quantitative score and a 70% weight to the qualitative score. As the domestic ESG fund is concerned, any company which scores above 0 is eligible to be included in the portfolio. So the key difference that we'd like to highlight between the research which we do in-house versus the third-party research reports is our engagement level. So our engagement is with a much larger ecosystem. We tend to seek information from a variety of sources. Rating agencies may only engage with company managements and may ask them to clarify or disclose certain information. What we do is we interact with various actors of the company's supply chain. We attend various dealer conferences, seminars on sustainability. At times, we've also visited the manufacturing sites. We've talked to the plant heads. So meeting a much wider group of stakeholders also gives us an additional comfort level to support our thesis. So with that, I think I'll hand it over to my colleague Natraj once again.
Yeah, I just take 30 seconds here. I just want to introduce my colleagues, Sam, Tully and Chirag Mehta, who joined me. Sam is based in London and joined Quantum in 2021 and heads of business development efforts in UK. And he's well versed with India, and he can challenge my Hindi too at times. Chirag is part of a responsible investment team and has been part of Quantum for 2 decades. With this, I will hand it over to Stephen and Richard, and we are here to take any questions if you may.
Can I just thank you for that? That was very interesting. I just wanted to bring up another point about concerning regulation. Obviously, Quantum's not a member of PRI, but in March of this year, the new EU Sustainable Financial Disclosure Regulation, SFDR, came into force. And this is a part of new EU regulations broadly designed to support the redirection of capital into more sustainable businesses. And it will require investment management companies to provide disclosures surrounding sustainability for all companies. And I think it's going to be introduced in two parts. It is going to be introduced into two parts, into two phases. So the rules introduced in March 2001 will require that all large investment houses above 500 employees must publish their sustainable policies and processes in detail and be gathering sustainability data about the companies they invest in by January 2022. Smaller firms below 500 employees can decide to opt out, but still must state clearly why they choose to opt out. And the second phase will be introduced in June 30th, 2023. And fund and asset managers will be required to publish their data. So I'm just interested from your perspective. I mean, there are other initiatives. I mean, obviously in the States with the Biden administration coming in, I can see new regulations coming into force in the States around sustainability. In the UK, the government themselves are looking at introducing new regulations. And I'm just saying, as from your global perspective, from a Quantum global perspective, how do you see some of the new regulations coming in? How do you see that will change or move the dial a bit in terms of how particularly investee companies, because that's, I think, one of the criticisms of the EU, one of the criticisms of the new regulations coming in from the EU was the investment management industry said that they would preferred the regulations, new regulations would have been imposed on companies, investee companies or companies around their ESG credentials. So I'd just be interested just to get your viewpoint on that.
So if I can sort of take that, Stephen, thanks for that question. I mean, we're very clear. So Quantum was set up 31 years ago, and we're very clear that while we are India focused, we're very clear that we'll follow the best practices globally. So we've started processes and practices way before they become law in India or in the Europe or the US in some extent. And while the laws in Europe don't directly apply to companies in India, they certainly will direct capital to those parts of the world which will adhere to the laws that apply in Europe for European investors. So though we are a small company with less than 500 employees, we're going to be opting in for everything. We're going to ensure that the practices, the policies, the compliance manuals, to ensure that we're actually doing what we have said in our policies. We actually, for example, on the governance side, we have something called the Compliance Monitoring Committee, which ensures that while we have a manual, are we actually following through with it? So we will, over time, adopt all the practices that we think apply to us for our clients from Europe or the US coming into India. And at the same time, the Indian regulator is very aware of what's happening around the world. And the Indian regulator is forcing Indian companies, so that for us to get information from starting March 2022, there'll be a lot more disclosures available. Now, we may not have a track record of disclosures because it'll be the first time that many companies will report, but there's no doubt in our mind that we will continue to adopt and listen and learn from what's happening outside and make sure it happens within Quantum and in our portfolio companies. And to take the point a little further about PRI, what Carl said, we don't have anything against the idea of sort of registering with someone. But if that registration is kind of a self-attestation, we're not going to be party to that. To us, people should actually audit and check that the approvals that are given are really meaningful, as opposed to, it's just a stamp in some sense.
Okay, thank you for that. I mean, the other point I just wanted to bring out too was obviously get your viewpoint. Obviously, from what you're doing, you review ESG monitoring. How do you compare that with, say, in the Indian subcontinent to say, some of the some, entities in the Western world that would be doing something? Because from my perspective, I would think it was more difficult from where you are than, say, for a European entity in Europe or in the UK or potentially in the States. That it's probably more challenging for you, Quantum, to actually extract the information. So just be interested just to get your viewpoint on that.
Absolutely. One of course is the fact, as Carl indicated, Nataraj did too, that more information is being made available to us. So as more information is being formally made available, that's great. In the meantime, we have to do all these cross checks, by checking with suppliers, checking with the pollution control board to see if any reports were filed against a factory in a particular district in India. So that's not all consolidated in one place. You have to go out there and hunt for information. So it'll be obviously a person in Europe and the US, because of the levels of compliance and regulation that may happen in this year and the next year, there'll be a lot more information. In India, we have to struggle to get it. But as I indicated, the Indian regulator is very aware of what's happening around the world and is really on the ball. And in our view, by March 2022, a lot more information will be available to us. But still, it is still India. It is a place where, we've seen over the years, you have companies that exist in India who are a combination of Enron and WorldCom and UCOS, and they're all in one company. And you have no idea which of that three-legged stool is going to break first. In a very similar way, on ESG, everyone is going to talk about doing it, but we have to check and see if they actually are doing what they state they're doing. So one is the reporting, the other is a verification of the portfolio companies. So I think for a while, it'll be easier for an India-based manager to understand what's happening in India than for a European manager or a US manager to try and do ESG from long distance, or even for the global firms. I think a lot of the global firms who are doing ESG reporting are doing sort of desk research. And the only reason we created a proprietary ESG process and database was because we could not get something of quality that fit our standards from the international suppliers. We asked them for reports of companies that we knew we would never buy for clients. And when we got those sample reports from them, they had glowing ratings. So we said, hey, this is something very different. Let's just build our own. So it'll take time. It will happen over the next 3-5 years. I'm sure many of the international groups will learn and will build capacity to handle the issues of India, Indonesia, Africa, and other such nations. But until then, we're kind of probably in the front of that, probably leading in terms of practice and implementation of ESG in India.
Can I just add one thing there very briefly, Stephen? I think you touched on two aspects here, which are absolutely right. One is the quality of the partner and the investment manager, and two is actually the process of ESG that surrounds the companies. What Quantum is trying to do is address both of those, walk the walk itself, but also in terms of the investee companies. And that's the challenge for ESG investors everywhere.
Okay, that's yeah, I understand that. And I think it's going to be interesting. Obviously, as there seems to be a plethora of, there's vast interest now in if we just keep it as ESG projects, top products, which is going to continue to grow. So there's going to be a developing field, and it'll be really interesting to see where we are in 5 years' time with, in terms of monitoring and how investment managers and particularly, investee companies are coping and providing the information the investment management industry will require to comply with the regulations, etc.
From my side on this, I think there's a couple of sort of very one of the most important points actually I think was really near the start of this, that returns aren't being sacrificed to follow the ESG principles, and I think that's got to be a key message to potential investors everywhere. Is that here, I mean, quite clear, you're very serious about what you're doing on the ESG side of it, and the result of that, though, is that you're choosing companies to invest in which are still able to deliver the sort of returns that investors are looking, and you're outperforming indices. I mean, within that, do you end up taking any type of an activist role as in sort of going to target companies that you might want to invest in, but aren't quite making a grade and saying to them, look, guys, you know, if you do X, Y, Z, you know, then you'll become a company we can invest in.
Yeah, absolutely. I mean, we have over the years, over the last 14, 15 years, we have engaged with a lot of companies. In fact, one of the last points in my slide when I spoke was that we're not a very popular group because we have confronted, spoken to, gone to the press, written about instances or experiences that we've had where certain companies have, you know, in our view, done things that are not right, either from a minority shareholder perspective or for society or for the environment. And we've actually, as recently as February, March of 2019, we actually sold shares in one of India's blue chip companies because we had a very different perception from the management in terms of, we went to meet the CEO and told them what our views were, and they gave us a counter. We didn't agree with it. And we said, if that's what you believe and that's what you're going to implement, we're going to sell our shares. And we actually wrote an article on it. I reached out to a couple of the large global groups which have shareholdings in that company and said, look, this is our discussion with the management. We're selling our shares, we've, you know, whatever it is. And they actually have been buying more shares. So, you know, again, ESG, like beauty, lies in the eyes of a beholder. So there's no one right number for ESG as such until we have standardized reporting mechanisms around the world. So it's, yes, it is perception right now. And each of us may have a different lens in which we're looking at the company. But if we're uncomfortable, we'll sell. We have no problem with that. I mean, of course, we'll have a dialogue, reach out to the company, maybe write letters to the board, meet the CEO, et cetera, but if there's no response, we're out. And then we kind of blacklist that management team or that group, you know, until they prove otherwise over time.
Well, I suppose the opposite of that, you know, if they don't respond, they're out. Presumably, sometimes they do respond and you actually see changes for the better.
Absolutely. So about 4 years ago, there was a bank in India which had a CEO. The CEO there were some allegations about the CEO. We held a small number of shares because we were not very, very comfortable on the sort of the transparency or the governance. And the minute the CEO was removed, and we actually wrote to the board, and the minute they took the CEO out, we bought more shares, and it did extremely well for us, the stock. So absolutely, yeah. But you know, I would say if I look at our own track record, out of every 5 that we may have engaged with, we're lucky if 2 come our way. Most likely, you know, 3 or 4 will make us sell and kind of get out because they think we're stupid. And, you know, we're kind of raising issues that are not there. But having said that, I think corporate India, and I think Nataraj and Carl can expand on this, but our engagement with corporate India today is much more open on ESG factors. I think including the guys who do the power plants, right, Nataraj?
Yes.
NTPC.
Yeah, so almost 50% of emission, GHG emission from India comes from the power sector. And we have, you know, held companies, one of the largest thermal power company in India in our portfolio. And we have engaged with them over the last 4 years on new projects that they're setting up in forest areas, existing products, what improvements that they're doing, and the next 5-10 year pathway in terms of their intent to improve. I think all of those feedbacks have been accepted. And in fact, the sustainability report, what they started publishing about 3 years back and what you see now, there's a world of difference in that. So I think some companies do respond quite significantly, but others are still in the early part of adoption and understanding of ESG, the scope of emission, how to measure it. I don't think there is one standardized way of looking at measuring emissions. So in that path, some are ahead, many want to improve, but some are very clear. And we don't want to shake hands with companies who don't have any intent to improve governance. Because if you don't have any intent to improve governance, you may do the most greenest of the plant and have 100% gender equality. But if the principles and ethics are not right, we feel the S and E will never get right over the longer period of time. So while we will engage with companies with intent on good governance check, but an intent to improve. We will never engage with companies with bad governance, but good SME.
Okay, thanks. I'm conscious of time. I just want to, I mean, just to kind of, you know, complete the session now. I just wanted to, what we've been talking about in the last 5 minutes, just the contradictory nature of this. So there was recently a Wall Street Journal report that highlighted that 8 out of 10 of the so-called biggest sustainable funds in the US are actually invested in oil companies. And it's, which seems odd because, you know, oil companies have somewhat a colourful environment track record. And the explanation from the managers on this was that they designed their sustainable funds to offer investors a similar level of risk and return to those they would expect from a broader market index. And I suppose that sums up some of the contradictory, you know, nature of what you're having to deal with. And I think what the industry as a whole has to consider when it looks at investing in investing companies that are holding themselves out to be, you know, ESG or sustainable or green or whatever.
Yeah. So Stephen, if I can actually take that a little further, right? How far do you want to go on the ESG chain? So if you look at India, about 65% of our entire power comes from coal, gas, you know, from dirty sources, if you will, of greenhouse gases. And it's not going to change for the next decade or two. So if you like a tech company, TCS, Infosys, who've got wonderful campuses, who are very green, and they may have all the greenness, you know, guess where they get their power from? Their power comes from a dirty source. So you can say, okay, in that case, I'm going to dump India. I'm not going to touch anything in India. But I think it's important, as we've shown in the macro slides, that investors need to recognize the need to engage with India and to ensure that by putting capital in companies that are exhibiting a very significant and serious path to turning green, to turning better, and not just about the environment, but also in terms of SDG, the UN's 17 sustainable goals that are actually moving society to that. Those are the companies to reward. Those are the companies to engage with. If there's a company that is stubborn and sees nothing wrong with what they're doing, and they'll be happy to just burn the planet in the process and burn society around them, you know, those are the companies to disengage from. I think it's very important to recognize that distinction, that someone could be subpar today, but with capital and coaching and guidance becomes a superior player in that industry. That's what you want to support and back. I think, to me, that's a real analysis. And it is subjective, right, to some extent. It is subjective.
And in that respect, you know, that ultimately should be the goal of the investor, is that, you know, they should be looking to not just be investing in, you know, green ESG products, but they should be investing in a way that will actually see companies improve. And I think this is where we see, you know, the activist side of the sort of things that you do, that you are, you know, looking at companies, you're encouraging them to improve. Right. And this is what the sort of thing that should be demanded, I think, of any manager. They need the manager to, you know, use the phrase you use, look beyond the optics, look beyond what's presented to the real details behind. And you need a manager who's going to be willing to go in there and say to the board, you need to do this. You need to improve your governance. You need to improve the, you know, your societal impacts, the you know, the amount of numbers of women employed. You need to improve the work conditions. At this point, you know, the investor can now see that their money is not only being invested in, you know, good companies, if you like, from an ESG perspective, but also it is making a difference. It's making that impact, which is, in theory, what the ESG investing should be about.
Absolutely, Richard. And to take your point to one other, you know, logical conclusion, if you will, is that when you find these large pensions and global sovereign funds allocating to an index, a passive index, they are actively supporting bad actors and bad actions. That is the real dilemma, that you have index investing, passive investing, which is supposedly low cost and may be good for the fund manager because of the good for the investor because of the low cost, but it could be terrible outcomes on ESG because the indices are full of pretty crappy companies who are bad actors, you know, because they're not being gauged for what is good. They're being gauged for market cap and profits, not how they derived the market cap or the profits. And that's the dilemma that's out there to me from an investor allocation perspective. Do you go for low cost and go for an index fund, and then you're actively supporting bad stuff? Which is why when we looked at the India Responsible Return Offering International, we said, you know what, the first thing we should do is keep the lost cost equal to that of the ETF or the index. Keep it a low cost product. So at least investors can see, okay, the costing is the same. And now let me see who's active on ESG and who's actually actively supporting dirty ESG, right? That should be the big discussion in our view.
Agreed. And I think, as Steve indicated, we are really sort of running out of time and drawing to a close. So we have covered, I think, all of the points promised, and I see there are no open questions as a result of the ideas we've gone through and spoken about. So I think it just remains for me to thank the team at Quantum for really insightful talk about the issues in green investing, but also highlighting that, as I said, you can get the returns of any other type of investing, but at the same time you are seriously having an impact as long as you actually are careful about choosing the type of manager and the type of investment you put your money into. So you need to make sure, and this is the whole point about sort of looking at the greenwashing, and beyond that to the eye-washing and the hog-washing, that you must make sure that the manager is doing the work to make sure the companies they're investing in are doing what they're saying they're doing. So with that, I think it's thank you very much, everyone. Thank you, Steve. Thank you, the Quantum team. And with that, we'll close the presentation. So thank you once again.
Thank you.
Thank you.
Bye-bye.
Bye all.